Hello YouTube, my name is Jake, and in this video I want to share my thoughts on the Fed's new strategy on inflation and how this will affect the stock market and what to do about it as an investor. Due to the recent coronavirus pandemic, the Fed has been lowering the interest rate down to near zero and bought bonds to stimulate the economy in hopes of increasing the growth rate and reduce the unemployment rate. However, this extremely low interest rate caused an oversupply of money and went straight to the stocks, real estates, and other financial markets with the coronavirus stimulus package. When the interest rates are low, it is a sign from the Fed that it is easing the credit market by creating the best environment for companies or people to easily access the capital for new businesses, business expansion, investments, or simply to spend. This easy access money will eventually end up propping up the overall asset prices to go up due to inflation. Inflation happens when the oversupply of money causes an increase in demand for goods and services, which causes an increase in overall price for goods and services. As a result, it affects the stock market by companies reporting earnings surprises, which increases the investors' expectations to buy more stocks, or investors have more money to invest to push up the prices. For real estate, a loose credit market will allow more people to buy properties easier than before with low interest rate, which causes the demands for investment properties to spike, and since the oversupply of money devalues the money, this will cause landlords to increase the rent price to offset the lost value to keep up with the inflation rate. Since the investment property values are based on income, an increase in the rent price will cause the property values to go up over time. This overall investment optimism created by the easy credit market environment will eventually lead to a bubble. On the other hand, when the Fed decides to increase the interest rate, this is a sign that the Fed is tightening the credit market to control the inflation rate. Because if the inflation rate gets out of control, the consequence of hyperinflation causes a severe devaluation of money, which can lead to catastrophic downturn on the overall economy. This credit tightening pressure will cause the debtors who cannot continuously increase their income to cover the debt to ultimately default on the loan because you must earn more than your expenses. Since debt is another person's asset, when the debtor defaults on the loan, the creditors lose their income, which causes them to spend less money than before. This will trickle down, which will then affect the overall economy and cause the bubble to pop and bring recession. This is why many investors are highly focused on the interest rate trends to determine the current position of the cyclical cycles of the economy. Historically, the Fed has been targeting the inflation rate at 2% as a signal to whether to increase the interest rate or not. However, on August 27, 2020, the chairman of the Federal Reserve, Jerome Powell, announced a new strategy or price stability on inflation by targeting the inflation rate at 2% on average over time. Note that this number is average, meaning the inflation rate could go higher than 2% from time to time, and Jerome Powell did not specify how this 2% average inflation rate will be determined. So what does this mean for us as an investor, and what should we do about it? After observing the Fed's decisions and the political trends recently, I believe that the equity market will rally much longer than we expect due to coronavirus pandemic outcome. Here are my reasons for why that is. First, the Fed's decision on increasing the interest rate is highly unlikely at this point because the US recently reported its second quarter GDP rate at negative 32.9%. And if the Fed decides to hike the interest rate now, it will destroy the US economy for good. Second, the low interest rate environment with the new flexible inflation rate policy will flood the equity market with more money than ever before. This in which will cause misalignment with the fundamental value of the stocks by pushing up the prices even more. And we are seeing this happening already with the S&P 500. Its PE ratio currently above 29.46. Lastly, President Trump will try to keep the low interest rate environment for his re-election and to push his political agenda against China, which I will talk more about in detail in another video later. On the other hand, the gold price has been rallying recently due to the low interest rates and high inflation rate expectations. However, long-term wise, stocks have always outperformed gold, but it is always smart to diversify your portfolio wisely because uncorrelated assets will give you a higher return over time. Understanding how the interest rates and inflation affects the stock market are just as important as understanding how to analyze the financials of the company. Think of it like you're playing a video game, and just like how you must understand the rules of the game in order to beat the game. To beat the market, you must understand how the market works and the rules behind it and collect all the knowledge that you need to achieve your goals. This is why understanding how the monetary system works and the shift in political trends are all important for investing. I hope that this video helped you understand how interest rate and inflation impact the overall stock market and what to do as an investor. Please leave it a comment below with your thoughts, and if you like this kind of video, please give it a like and consider subscribing. Thank you for watching.